Right, good afternoon, everyone. Can I introduce you to Simon French, who is Chief Economist at Panmure Gordon, also a regular commentator, particularly with his own column in The Times, and obviously has been, with so much news over the last 4 to 6 weeks, has been commentating even more than usual. Now, fun enough, it was about 2 to 2.5 weeks ago, I reached out to Simon, who's very kindly done a couple of webinars with us before, and said, well, actually, it might be quite interesting to do another one to see if we can work out what Kwasi Kwarteng may U-turn on over his mini budget. That was 2 weeks ago, and obviously since then, those U-turns have largely happened, I guess, and obviously the Chancellor has been replaced. So the agenda is slightly different to what we originally thought because things have moved pretty quickly. But even so, obviously, it's a good day. Obviously, we've got a change of government today to sort of have a look at where the UK economy is holding, and obviously we still have that mini budget and then an MPC meeting next week. So as usual, we should be here for just under an hour. Simon has a presentation to run through. Please do ask questions. We've got some questions that were pre-submitted, so we have time for questions, and we'll try and include them during if we can, and if not, we'll cover them off at the end. So thanks again, and I will pass over to Simon.
Thank you, John, and thank you to the Landbay team for inviting me back. As John said, this is the third time I've delivered a webinar in 3 very different economic times, and the half-life on producing economic presentations is shrinking all the time. And if there's anything that we can hope for from today's events, is that half-time elongates out again. It'll certainly make my job a bit easier. But what I'm going to try and do over the course of the next half an hour, 40 minutes, and hopefully leave time for questions, and I know John likes to keep it quite interactive, so we'll probably come in on some of my slides, is run through how I see initially in the first section, global economic events evolving from here. And then sort of narrow down into the UK economy, and then more specifically into very much the topic du jour, which is UK residential, UK broader property markets, and the impact that initially globally rising interest rates have happened, but in recent weeks this becoming a bit more of a UK specific story. In terms of my slides, they're available. They should be, if you want them, you can have them after the presentation, but they should be on the screen in front of you, but I'll talk to them in any case. 4 sections over the next, let's say, 35-40 minutes, covering off at the start the fact that a global economic slowdown is well underway, and that is a very deliberate action from central banks trying to catch control of inflation, which has been, if you were to go back and watch the recordings that I made previously, I didn't see inflation at this scale. I put my hand up. I think the economics profession more broadly we are bruised by this experience. Yes, we didn't see a war in Ukraine that has obviously amplified this, but equally there were some signs that divided the economics community, and it has to be those people who warned of inflation have had their warnings age better than those of us who are more sanguine. But, and this is my second topic, inflation is now showing signs of peaking, and I put in parentheses, at last. It does feel like it's a long time coming, but there is quite a lot of broad indicators around in shipping markets, commodity markets, that haven't necessarily passed through at this stage through to consumers, but there are hints that central bankers are watching this, and in the last few days actually the FOMC, this is the committee that set interest rates in the United States, who have really been driving this big interest rate move that has impacted global financial markets and of course residential real estate markets. They are showing signs of perhaps slowing down their pace of increase as we go into the turn of the year. Turning to the UK, UK politics unfortunately has introduced a new UK risk premium. So some of the big global factors that had been driving equity markets, asset prices, had an additional, if you like, UK overlay as a result of the Truss Kwarteng administration. That's starting to unwind, and actually unwound quite a way since both the appointment of Jeremy Hunt as Chancellor and now Rishi Sunak as Prime Minister. I put in a bullet point here, right ideas, but terrible handling and poor timing. And John very kindly references my Times column in today's paper. I do very much talk about what Rishi Sunak actually said in if you like, praise of his predecessor, that she had the right ideas, but there were mistakes made along the way. And I'll go through some of the details of that. And then what do we have to come in terms of, if you like, a recovery budget from both Rishi Sunak, the Prime Minister, and what I expect will be Jeremy Hunt. No confirmation that he's going to be Chancellor, but I think Rishi's going to try and minimise, if you like, disturbances, disruption. So continuity of a Chancellor of just over a week, that classes as continuity in the UK economy at the moment. But I will finish by saying the actors may change, but the stage on which they're playing is very much the same in terms of cost of living squeeze, trying to deal with the fallout of Brexit, a secular move up in interest rates and the impact that's having on asset prices. Those of you who've attended my webinars previously will know my presentations are pretty chart heavy. So here's the first of them. And this is just to say that a global economic slowdown is underway, following what was a very, very rapid recovery. If I go back and, if you like, look at my previous webinars, the comments I made the point at the time that labour markets, activity, services industry, the manufacturing services, they recovered very, very fast, and much faster actually, and this is the right-hand side of the slides in front of you. If you mark to market global trade volumes, which is a decent proxy for economic activity, the dark blue line is the rapidity with which global trade recovered after the COVID pandemic, after a similar drawdown as during the global financial crisis. And now well above, and although starting to level off, well above the kind of levels that we saw in terms of the post-global financial crisis recovery. And one of the reasons why inflation has been so strong is that the scarring, if you like, that normally is associated with a recession of that depth largely didn't happen this time round. Labour markets healed pretty quickly. Economic activity returned. It might not have felt like it. It certainly didn't when I was sat in my front room, but economies recovered relatively quickly. And therefore, some supply constraints started to emerge much quicker than they normally do during economic recoveries. But the left-hand side, the PMIs, the Purchasing Managers Index, this is, if you like, the monthly bellwether of economic activity, now below the line on both measures, below the line being 50. Anything above 50 is expansion, anything below 50 now signalling a contraction. So we have recessions pretty much baked in for the second half of the year in most of the major economies around the world.
And Simon, can I just ask there, in terms of, I know you'll come on to UK, but is that true for the UK that actually Q3, almost certainly we were in recession, or is there any chance that actually that doesn't happen, or it happens in Q4 rather than Q3?
John, it's an excellent question, and as usual, I know you're absolutely all over the data, probably as much as I am. We thought Q3 would be a quarter where the UK economy avoided recession, but I have to say the events of, very, very sad events, obviously, of the Queen passing, that introduced a new bank holiday into the September data. And I mean, whether one looks at that as if you like, an artificial measure of economic weakness, it will come out in the last month of of Q3, which will be a big drawdown. If you look at previous bank holidays from the silver, the gold, and the platinum jubilee, they have been drawdowns on economic activity. So what we thought otherwise would be a recession in the fourth quarter and Q1 next year, so a two-quarter recession, as a result of those sad events, looks likely now to be a three-quarter recession, starting in the quarter that's just concluded, and now goes through Q4, Q1. In terms of trying to quantify a lot of the stuff that you will be seeing in terms of, everyone's got their preferred financial metric, interest rates, equity markets, bond spreads, currencies. What we try and do at Panmure, or what my analysis tries to do, is bring that all together in a technicolored chart in front of you, which tries to ascertain what that is doing to financial conditions with the thesis, not a reasonable back-tested thesis, that if financial conditions are tight, and that is anything above the line, above zero, that is slowing the economy, its interest rates being prohibitive to activity, currency movements, equity market valuations being prohibitive, and anything below the line being very supportive of financial conditions. And John and I were chatting just before we sort of clicked start on the webinar as to some of the questions he'd fielded before the webinar today about, well, what's normal in terms of interest rates and in terms of financial market conditions? And if you like, what is unusual perhaps over the last decade is how much persistently below the line financial conditions have been supporting economies through low interest rates, a rally back in equity markets, supporting the wider economy. That looks quite unusual in terms of its historical oscillations. And what has happened most recently is this big, at the end of the chart there, this big spike up in financial conditions, almost across the board, spreads, mortgages, corporate spreads, big movements in equity market valuations, and of course, central bank interest rates, all contributing to now financial conditions by that weighted measure, our own financial conditions index, being at levels we haven't seen since late 2012, if you like, the height of the euro crisis and the prolonged impact of the global financial crisis. So I think in terms of trying to calibrate where we are, two takeaways from here. One, the most tight financial conditions that we've seen in a decade. But secondly, the fact that that period over the last decade does look quite unusual and quite how supportive financial conditions were. It was enabled by the slow recovery, by generally benign global inflation. This has now been a rapid economic recovery. It has now lit quite a lot of inflationary pressures. So financial conditions are having to lean into that at a level that we just haven't seen for a decade and look a little bit more, if you like, normal than the last decade that we've experienced. Having depressed you, and I hope, I don't mean to say that, but no, I'm very mindful when I'm presenting at the moment that one can't hide away from the difficult economic messages. You'll be seeing it in your businesses, in your household budgets every day. So pointless trying to gloss over them. But having seen some absolutely extraordinary moves in commodity markets, there are signs that the worst is over. There's a lot of red on this, and you might go, well, hang on, how's that good news? Red is normally that sort of danger sign in nature. The red, though, is largely behind us, and there are little signs of green. What am I trying to show here? I'm showing shipping costs on the left-hand side, and the dark blue line is the average cost to ship container around the world. This is a weighted average of all the various shipping rates around the world. And what happened as the pandemic took off, and then a lot of consumption of goods versus services was required, huge pressures on shipping volumes, some of the breakages, in terms of breaking down containers and shipping them were disrupted by social distancing, meant that we basically had a six-fold increase, a 600% increase in the cost of shipping basically anything around the world economy. And we have such an interconnected world economy that was a huge input into the cost of doing business. Not directly if you're in the services industry, but indirectly through a lot of the items that are necessary to do business. But notice how that chart has, there's no other way of putting it, collapsed actually during the course of this year, to the point where we now, and this was data as of close last night, shipping costs are still twice what they were prior to the pandemic, but have dropped by a staggering amount, more 60% year on year, and coming down very, very fast and showing no signs really of leveling off. So perhaps returning to the levels that we saw pre-pandemic. And if you're thinking of the things that permeate through inflation, it doesn't matter whether you're buying basics range pasta down at Tesco or whether you're buying heavy capital machinery, at some point, shipping and transportation come into contact with that. And therefore, this is the first signal that the worst in terms of inflation is over. Slightly slower to come down, but still now pretty much flat year on year, is what's going on in the broader commodities complex on the right-hand side here. That number is still elevated because of high energy costs, particularly natural gas in Europe. But even there, as I'm going to show later in the presentation, there's some emerging good news. But overall, if you think of those as the two big input cost pressures in the global economy, there are now, if you like, sufficient signs to think that the big prints that we've seen, 8, 9, 10% inflation, are probably going to be behind us as we head through the turn of the year and into next year. None of us have the, and I have to put this disclaimer, none of us have the gift of foresight in terms of the big exogenous events, war, pandemics that might come down the track. But just based on these being decent leading indicators, it's a decent sign that the worst is over on inflation. Moving a little bit closer to home and talking about the energy market, the commodity market in terms of natural gas, you may wonder, well, what does that mean for inflation? And I put this chart together. This chart has been in my presentation pack since the end of August. You may say, well, that's a very precise time to put together a slide. At the end of August, a lot of economists, a lot of people went on holiday, and it led to a little bit of a silly season amongst those economists that stayed in their seats, particularly in London. And they started putting out forecasts for 18, 20, 22% inflation, based on some extraordinary spikes in gas prices. And this now former Prime Minister Liz Truss saying, well, we're not going to bail UK households, UK businesses out. And what you've got on the left-hand side here is what would have happened had you had no intervention at all in the energy market. The lightest blue line we would have suggested inflation may well have peaked in April of next year, of about 17%, an extraordinary high inflation rate. The result of intervention through the energy price guarantee is more likely to deliver the dark blue line. So inflation likely to peak in the current month we're in, October, and then start to come down relatively rapidly as household energy costs remain capped from their October level for now 6 months rather than the full 2 years, and energy costs for businesses similarly. Now, I put a big line there saying policy uncertainty. The reason that is a uncertain picture is, of course, at this point, we don't know what happens beyond April. So that was still conditioned on a 2-year guarantee for households. Clearly, if Jeremy Hunt, Rishi Sunak, the new UK cabinet decide to put more of the, if you like, the onus to pay for energy back on households and businesses, then you would expect that line to move back up towards the light blue line, but certainly nowhere near that, given, I don't think it's conceivable for households to absorb £5,000–6,000 a year fuel bills for the average household. So a big impact on inflation from the policy intervention, but I have to acknowledge there is deep policy uncertainty on what the energy price guarantee does beyond April. I'm very happy to cover that in more detail in questions.
And Simon, on that, I just noticed, and obviously with the caveats, obviously there's a lot of policy detail to come out, but even at that level, I mean, you're not predicting that inflation gets down to 2% in that period. So it stays above target, maybe just a little bit above it at the end of beginning of 2024. But broadly speaking, it looks like it's sort of settling around about the 3–3.5% rate in terms of what you're saying.
Very, very good. I mean, your eyes are better than mine, honestly. But you are right. After having seen the underlying data, you are correct. Why? And this is where sometimes economics needs to bring in both the data, but also the anecdotal stuff that we're seeing as at Panmure. We're brokers to about 100, mid-sized UK companies on the public markets. What we're hearing is a lot of those big price shocks that have come through in the last couple of years have not been passed through in full to their customer base yet. A lot of businesses are saying, look, we can't pass through to our customers 15–20% cost increases in one go, but we may well go 5–5–5 or 6–6–6 in terms of salary increases, in terms of price increases for their goods and their services. And therefore that, for me, illustrates, if you like, a bit of a stickiness of inflation as a result of these huge events that mean that we'll see a staggered pass-through, and in the parlance, quite sticky inflation above the kind of 2% level, which, if you like, and I know you're sort of teeing up that question, which is, what does that mean for interest rates potentially starting to come back down? Well, I think if central banks are going to be facing still inflation at their target or indeed somewhat above it, it's going to be quite difficult for them to make the case for aggressive cuts in interest rates from where they're going over the next couple of quarters. But I did say there was some good news as well on energy itself, even though this is doing so much of the heavy lifting. I apologise a little bit for the slide on the right, or the chart on the right here at page 5. What you have at the top line was the forward gas curve for the next 2 years for buying UK gas on the day that the energy price guarantee was announced on the 8th of September. And that was what, if you tried to go out into the wholesale market and buy gas for delivery over the next 2 years, you'd be paying £4, £5, £6 per therm. And the energy price guarantee, the dotted blue line, basically capped it at about 185p. So everything, if you like, between those two lines was us, taxpayers, paying energy companies to keep their tariffs at that dotted line level rather than the light blue line at the very top of that chart. The dark blue line is where it was last night. And you will notice that's come down a long way. And what that means actually is the liability for the exchequer, so the amount the taxpayer, the Treasury are going to have to give the energy companies, is coming down, and coming down really quite rapidly. Not below the line yet, although November delivery is this morning, it was pretty much on that line. But obviously, the further it comes down, the less the taxpayer is going to have to pick a bill, and the less, if you like, black hole exists in the government finances as a result of providing this energy price guarantee. So the good news since the 8th of September in the gas market, as a result of decent storage levels in Europe, a warm start. Anybody who's been outside today knows it's a pretty warm start to the autumn. That's doing quite a bit of the heavy lifting as well. But look, if you like, at the last line on here, which is the decade average for gas prices prior to the start of the year, about 50p per therm. So even if we get down, and it's a big if, we get down to the energy price guarantee level, that's almost 4 times what it was pre-pandemic. So it's still going to be an income shock to households, squeezing their disposable income, the affordability for other items of expenditure. So we mustn't lose sight of the fact that while the liabilities, the news has got better, we're still way out of kilter with anything we saw over the last decade in energy markets. Talked a lot about inflation, prices, but there are, of course, other things going on in the UK economy. And long COVID does remain a big impediment to economic growth. On the left-hand side here, we'll see the number of people who are classed as inactive. Those are people aged 16 to 64 who are not either in work or on the unemployment register. So these are people who are either long-term sick, they are caring, they are students, they've taken early retirement, have other reasons to be outside the labour market. That'd be, for a decade or almost a decade, that'd be making steady downward progress. Fell by about 1 million between 2012 and 2020. And if that trend had continued, we'd be close to 8 million people today. Unfortunately, we're now above 9 million. So we think there's about an 800,000 more people in inactivity than pre-COVID. So if you're thinking about businesses reporting we're struggling to get workers, this, rather than the unemployment rate, is the big story here. And what are the big factors? I've badged it together as long COVID. I'm no epidemiologist. A lot of economists tried to reinvent themselves as epidemiologists in recent years. I'm not. But what I can see in the data is that, if you like, long COVID, the event, rather than the medical condition, has led to a reversal in what had been a big driver of economic growth in the UK. Some of these people are affected by legacy pandemic conditions of COVID, fatigue, etc. A lot of them, though, also are people who had pre-existing conditions whose treatment was interrupted during the pandemic and now are struggling to get back into the workforce. And then we have another couple of pockets of groups, students who've spent time on courses, which they do during every recession. They spend longer in academia. They're slowly coming back, but it's a very slow process. And then also the early retirees. And I'm mindful of time, and I can perhaps unpack this later, John, if you want to mark your card for questions. But the early retirees, the age 50 to 64, who during the pandemic maybe reassessed their life choices, did so off the back of rocketing values of residential property, their big wealth impact, positive wealth impact, to think they could retire with a more valuable asset than they went into the pandemic with. If interest rates do have the effect I suspect they will, which is to push down property prices, we will start to see, in my opinion, those older workers start to come back. But I can unpack that in greater detail if we want to at the end. The other big thing that's happened in the labour market is the big collapse in the number of people who are self-employed. Difficult again also to disentangle what's going on here. IRS rules, off payroll working, changing the incentives, if you like, to be self-employed versus PAYE. Similarly, the relative advantages of furlough versus the self-employment income support scheme was doing some changes here. But there's been no real bounce back in self-employment, at least not in the data. So we do seem to have lost some of the self-employed, and some of that actually is EU migrants who were self-employed, particularly in the construction sector, going home and not actually coming back thus far since the pandemic has started to ease. For this audience, I have to talk about UK housing. You want me to talk about UK housing, although I'm also mindful that there's going to be some deep expertise here in the sector. So I will keep it to the economic rather than the sort of deep detail of UK housing markets. It's based on our research. We publish, in my case, most weeks I publish a sort of thought piece, and a couple of weeks ago put out one on the UK residential market, which saw quite considerable real terms declines, about 28–29% over the next 3 years in real terms, adjusted for inflation. That's about a 14% nominal reduction in the average house price, based on our modelling of interest rates levelling off in around the 4% level. They may go higher first, but we think the if you like, the longer term level at the end of that 3 years is about 4%. A little bit lower than the market currently anticipates, but I still think there's a bit of a UK specific risk premium. And that UK specific risk premium can be seen on the right hand side here on looking at 5-year gilt yields or 5-year sovereign yields across 6 of the G7 countries. You may wonder why I picked 6 of the G7. Well, Japan is also part of the G7, but nothing ever exciting happens in the Japanese bond market, so I exclude it because it just skews everything. It's one of the extraordinary financial market assets, Japanese government debt. But the other, if you like, normal bond market behaviours over the course of the year, between January and July, the UK saw a bit of an undersized move, if you like, in the interest increase in its 5-year sovereign yield, the dark blue blocks, compared to other G6, in this case, countries. But the big move has been since August, when Liz Truss initially took office, unveiled her mini budget, and the interest rates that investors demanded to buy UK government debt, and the obvious pass-through to quoted mortgage rates, corporate interest rates, is quite an outsized move there, which has started to close and has closed, I think, by about 50 to 75 basis points across the curve since Kwasi Kwarteng was removed as Chancellor. But you can very much, I think, very clearly see there that the big moves in mortgage markets in the last couple of months have been driven by a UK-specific element that is added to what has gone on globally across the world in terms of rising interest rates. And you only need to look at the US mortgage market, with average 30-year mortgages approaching 7%, to know this is not a uniquely British phenomenon, but we've added a UK element, which Rishi Sunak's first task is to try and eliminate as much of that as he can by the 31st of October in the budget. I've dubbed it, because everyone's got to have a bit of alliteration, because otherwise the media ignore you. I've dubbed it the dullness dividend. And that's the prize, if you like, of being dull and boring and going back to talking about credibility and medium-term fiscal sustainability, all the stuff that was briefly unpopular, getting the Office for Budget Responsibility to model your economic outcomes, those kind of things. Showing how bond markets, and this time I have included Japan. Japan is basically the dead bond market, the black line along the bottom of the left-hand side here. But what you have is the other evolution of in this case, the 10-year sovereign yields. And you can very clearly see that, having been middle of the pack all year, that big increase as a result of the mini budget, and now actually the pullback was the reward was that pullback, the dullness dividend of why Rishi Sunak and Jeremy Hunt can make things through virtue of no surprises, more, if you like, grown-up approach to the economic trade-offs, can bring down sovereign debt costs, that cuts over the medium term, long-term debt servicing costs for the government, and of course for companies, for businesses, for households. This should start to be reflected now in new loan pricing as the wholesale market responds to, as I say, a degree of stability, a degree of dullness, no surprises, checks and balances, transparency, the stuff that all good businesses try and operate like, where the government, bluntly, for about 6 weeks, chose to try and go another way, and it aged pretty badly. What does this mean in terms of the Bank of England policy rate? Well, on the right-hand side here, you can see how the bank rate has started to pick up as the Bank of England, the Monetary Policy Committee, who meet again on the 3rd of November, how they've been passing through interest rate increases. The market sees further increases through to about the end of spring next year, peaking out currently on market pricing at about 5%. Now you see the dark blue dots were in the immediate aftermath of the mini budget. That was approaching 6%. So if you like, the pullback in terms of what the Bank of England is going to be expected to do, the markets can be wrong. This is only pricing based on options pricing in the London market. But there is a very considerable pullback across the next 3-4 quarters in terms of how high UK interest rates are going to have to go to deal with both the imported inflation of energy, but also what was going to potentially be a big fiscal package in terms of tax cuts and spending, which has since been rowed back. So still a spike up. Yeah, go.
Yeah, and on that side, as you were saying, I mean, it's still a big spike up. We're what, 2.25 now. We kind of, broadly speaking, doubles in the next 4 or 5 months, or maybe slightly more, maybe slightly less. But that would imply there's going to be a couple of moves, probably of 75 basis points. And so, in terms of where we sit in, I don't like to put it on the spot, but I will. But obviously, there's going to be one next week. It's there's some people who think that might be 100 basis points. Some thinking maybe actually that would do more harm than good because it might show the Bank of England is worried about something. How do you think that? Let's assume that's right. We end up at 4.5 to 5. Do you think the bank will do, a couple of very big moves, or they'll just do gradually?
Yeah. So, John, spot on again with the question, which is, in the immediate aftermath of the budget, markets were initially pricing 150 basis points. At one point, they were actually 175 basis points. With that coming through an emergency move in the few days after the budget, and then another move on the 3rd of November. But since we've had those U-turns, there is now a path to doing 75 basis points on the 3rd of November, which I think is where pricing is starting to arrive at, what I think will happen. I think 100 basis points was plausible before Jeremy Hunt's appointment, but Jeremy Hunt has brought a degree of stability. He's U-turned on some of the more controversial elements of the mini budget. I think 75 basis points is reasonable. Then in terms of where it goes next, this is where actually financial markets and the Monetary Policy Committee, so the 9 people who set interest rates, are perhaps becoming slightly at odds with each other. The Deputy Governor for Monetary Policy, Ben Broadbent, made a speech earlier in the week where he basically said that those dots that you see on your screen there look a bit rich to him in terms of, he didn't quite use those words, but I'm paraphrasing because, as always, these central bankers use these conditional statements and wrap it in jargon, but effectively saying he thinks that's a bit rich for what may be required, given some of the now evolving data in terms of shipping costs, commodity costs, and the impact that's going to have on bringing economic activity down, unemployment up. So he's suggesting that there may still have some further distance to drop. And if I take you back to what I said maybe 5 minutes ago, what did I condition my housing market forecast on? I didn't condition it on 5 or indeed 6. I conditioned it on 4. So I probably agree that with Ben that we're more likely, in my view, to end up plateauing somewhere closer to 4 than the 5 or 6 that we have on there, because financial markets, having been a bit scared by the inflation spike, are now a bit skeptical, and then they're sort of, I think they're perhaps overshot in the other direction. So I think there's still a bit to come down here. But in terms of normalizing mortgage markets, if you see a bank rate of 4, potentially if you put the lender spread on top of that, quoted rate still in that 5 to 6 range, I think that would be what I would go as in terms of a decent working assumption. So the whole this, both energy markets, but also rising interest rate costs, is generating a consumer income squeeze. Consumers have cottoned on to this. Consumer confidence is at very, very low levels, type of levels we last saw in the global financial crisis. But, and this is where my research sort of delves into some of the data around what the mortgage market looks like. About 80% of mortgage debt is on a fixed rate. And that is in sharp contrast to 2012, 2013, when it was about 3/4 of it was on a floating rate. Now, in terms of describing what that does, that delays the pass-through. The pass-through depends on the remortgaging cycle and the length of time you have left on your fixed rate deal. So clearly, for those people going right into the remortgaging market right now, it's a big shock. I'll make no mistakes about that. But the totals of people, bear in mind there are about 15 million outstanding mortgages in the UK. Only about 1.2 million of them will come to refinance over the next 12 months. With a further 3 million on top of that on the variable rate. So it's about a third of the mortgage stock will feel some quite considerable pain over the next 12 months. But you do have about 2/3 who, at least in the short term, will be insulated from interest rate increases. Now, clearly, households start to be thinking forward as to what might have to happen when they refinance, and therefore may bring that moment forward in terms of doing precautionary saving, and I'll cover that right at the end of the presentation. But I think it is important to not lose sight of the fact that over the last decade, we have made our secured lending marketplace less sensitive to interest rates than it was, as I say, back in 2012, 2013, and certainly what it was ahead of the global financial crisis. So worth just noting that, if you like, against some of the perhaps more hysterical commentary about UK housing. The other thing to note, this is a chart I've used in all 3 of my presentations actually to the Landbay team, is on excess savings, because this is still a big story. Excess savings, this is cash in deposit accounts around the country. It's so valuable as information because a lot of the data we have is survey-based data. This is admin data that the Bank of England provide, and we know it's there. And there was a big pickup in the amount of savings that took place during the pandemic. It started to level off now, but still well above, in terms of the stock of savings, well above trend. And in terms of having the resources to deal with a big cost of living squeeze. For a lot of households, albeit mainly high income households, this excess savings is part of their, if you like, their defense mechanism against what is a considerable cost of living squeeze. I think to lose sight of that would be remiss. I mentioned confidence, and this is where I draw to a conclusion. I think 2 more slides. Confidence is absolutely key. And on the left-hand side, this very busy chart is the savings rate. This is the proportion of disposable income that a UK household saves, and we've got 50 years worth of data there. There are 2 red lines, there are 2 red sort of arrows I put on the screen there, which were recessionary periods in the early 1990s and again in the global financial crisis, where savings, precautionary savings, picked up as a result of fears over unemployment, over interest rate costs, mortgage affordability, etc. And households basically said, right, households never do that. I mean, households are like investors. When they should be repairing, the roof while the sun is shining, they don't. They wait till it starts raining and then they call out the emergency tiler. That's the precautionary saving that took place in those 2 periods. The worry right now, if we ignore the pandemic spike, which we've just covered, the worry now is that you get a further precautionary saving pickup, which starts to become self-fulfilling in terms of then consumers are spending less in shops, then retailers are laying off staff, and you get a recessionary down cycle. It's why confidence is really key in households going, no, I'm confident in my employment prospects. I'm confident enough to draw down on my excess savings or other, leverage options in terms of unsecured credit card debt, loan debt, because I have confidence that things will get better and I'm, in effect, consumption smoothing. There are 2 uncomfortable historical parallels here. And if you like a number 1 in the in tray for Rishi Sunak today, it is to try and maintain a degree of, yes, he has to be realistic on the economic challenges, but he has to try and underscore confidence, because otherwise you get the type of negative consumption cycle that means asset prices go down further, businesses fail, and you get quite a negative economic cycle emerging. I'm going to finish in terms of my final chart on where we see house prices right now, and if you like, sort of supporting perhaps some of the views that I have that house prices are probably going to fall over the course of the next 3 years as they adjust to higher interest rates. Previous episode, so the red line is nominal GDP growth, GDP being the size of the UK economy. In theory, house prices should anchor towards that level. And when they go either side, they look overpriced or underpriced. And you can see in the early 1990s, they moved 2 standard deviations out. Again, ahead of the global financial crisis, they got out to about 3 standard deviations out before pulling back. They didn't pull back the whole way after the global financial crisis, though. And remember, of course, because interest rates plummeted at that point. And therefore, the rewards to owning a yielding asset, either imputed or real yielding asset, were supported by very, very low interest rates. One of the reasons why, okay, we're not at the same extreme in terms of standard deviations right now, one of the reasons why we may see it retrace closer to that dark red line is that you can't play the same trick this time round. Interest rate cuts that came after the global financial crisis to underscore house prices, very difficult to do in this inflationary backdrop. Having a 0 or near 0 interest rate is not going to be something that central banks can contemplate for a number of years. So during that period, I think it's entirely reasonable that the prices start to pull back in that direction. Oh, I said I had 1 slide left. I've actually got 2. So the reason I put in an extra slide is because John always likes to ask me about fiscal policy. And I talked about some of the fiscal challenges earlier in the presentation, but it's worth perhaps just calibrating what the 3 stages of fiscal policy repair are going to be, given big amounts of borrowing, which speak for themselves on the left-hand side of the chart. 220, 230 billion pounds worth of borrowing this year is a big number, and it's still rolling out into the end of the middle part of the decade, still borrowing close to 100 billion. So there's some reductions in that number to make. Some of that has been the rollback of changes from the mini budget, largely complete, stage 1 of the process. 2, on the 31st of October, so next Monday, a budget which starts to establish what kind of fiscal rules this government's going to stick to. So there's the credibility part of the story. And then start to talk about some spending cuts and potential tax increases to reduce that amount of borrowing you see on your screen. And then third, and this is, where all parties, doesn't matter whether it's Labour Party, Conservatives, governments around the world, are struggling by trying to get a political coalition for pro-growth reforms. This is what I wrote today in the Times. Liz Truss, she was right. There is an anti-growth coalition in the UK. She was wrong in terms of who they were, in terms of she kept out some key people, mainly because they were the people who voted for her. So people who were anti-planning reform, people who were pro-Brexit, also act as that anti-growth coalition because they are very obvious impediments to UK growth. But in order to get, if you like, a political mandate, a political coalition for that may, I think, require a general election. Clearly, Rishi Sunak's trying to head that off at the pass. But clearly, if he wants to make big progress on increasing UK growth, he's going to have to grasp the nettle on those issues regarding the childcare market, financial services, planning, immigration, Brexit, big things that if you want to grow the economy and therefore make higher levels of debt more sustainable, you're going to have to address head on. And my final chart is just a summary chart. My final slide is just a summary slide, just to say, look, the recent interventions, in our view, shallows the UK recession. The Bank of England back in August saw a 5-quarter recession. We see it, to John's question earlier in the presentation, 3 quarters, Q3 22 through to Q1 next year, and about a 0.7 peak to trough decline. Not an unsubstantial recession, but not a deep one like we saw after the global financial crisis. That delayed pass-through to energy and mortgage costs does buy the UK consumers time. And if you think about Rishi Sunak's challenges, he'll want as much to be a smart prime minister as a lucky, or he wanted as much to be a lucky prime minister. I keep referring to him as chancellor. A lucky prime minister as a skilled prime minister. If the energy market events in Ukraine move in his favour, then clearly the ability to buy yourself time through energy market interventions, mortgage costs, delayed pass-through, there's excess savings story, does give you hope that going in through to next year, things do start to improve. The labour market resilience is absolutely key to this. And I showed that excess savings, if you like, parallels previously. If we start to see confidence struggling to recover, we start to see precautionary savings. That's less spent in shops, less spent on construction and renovation projects, which has to start to have a cyclical downturn. So key, absolutely key, is to try and underpin confidence so that households feel happy to try and consumption smooth what undoubtedly will be a challenging few quarters ahead. John, I'm going to leave it there.
Fantastic, Simon. That was a really thorough. We sort of went through pretty much everything. But there's one area we didn't actually. We had a question about it, which is and I personally always think that a lot of talk around currencies and exchange rates are sometimes overdone in terms of their importance. But someone's made a good point. Is we often talk about what the Fed is. Increasing rates faster than anyone expected, and that is forcing us and Europe and other countries to maybe not keep pace, to maybe accelerate earlier than we would do. Could you just sort of explain, is that the case? Why does it matter that we increase rates, not necessarily in line with America, but why that would influence our pace of rate change?
Yeah, spot on. So almost every currency in the world this year has weakened against the US dollar. And so to some extent, while Sky News love to, I'm not picking on Sky News, but they love their ticker, don't they, of US dollar versus sterling, economic crisis. Well, in Japan, in the Eurozone, very, very similar moves, indeed more extreme moves on the Japanese yen as a result of all of this, because in contrast to the Bank of England and latterly the European Central Bank, the Bank of Japan have not responded with interest rate increases and have let their currency do more of the weakening to try and sort of support their export sector, try to take some of that heavy lifting. But even they have had, if you like, a so they've had to blink in that regard and have intervened in the last few days in foreign exchange markets to try and support the yen. So the dollar story has been followed, albeit slightly slower, by the Bank of England because they didn't want a big inflationary pass-through to be amplified. If you think about importing, energy into the UK, foodstuffs into the UK, a lot of the global commodities, both soft and industrial commodities, energy commodities, are denominated in dollars. If one weakens your currency, the persistence of that inflation becomes more amplified because it just costs you more in your domestic currency terms to import those things that are denominated in dollars. So the reality is that the Fed have acted, and we could have sat tight and said, right, we'll just let sterling, if you like, take even more pain. But I'm not sure UK households would necessarily thank us for that, given the fact that the type of food inflation, energy inflation we're seeing at the moment would be even greater had sterling fallen even further, which I think is undoubtedly what would have happened.
Okay, fantastic. And on this might link into some of the early retirees point you were making earlier, but I was looking earlier today for another reason, just to look at savings rates. So what return people can get on not instant access, but sort of 1 year fixed rate bonds and in banks. And at the beginning of the year, it was around about 1%. You'll get, and now it's north of 4%. And obviously that counter bit to early retirees is a lot of that savings money is likely to be sitting amongst the older generation, if that's a polite way of saying it, who may be retired. So they get a slight boost there. But also, is there any economic benefit, from that higher savings rates that will actually feed through into anything meaningful, or does it just help what is largely speaking those that are retired or close to retirement?
Yeah, so John, you very kindly at the introduction to the webinar said, I do a lot of commentary work with the media, and I do think, and I have to check myself a lot of the time when we're talking about interest rates, as not only describing it as a one-way street in terms of the contractionary impact of higher interest rate costs on debtors, on those mortgage loans, credit cards. There is also, as you rightly point out, a stimulative impact of higher returns to savings, and therefore that you have to net off some positive consumption effects for those people with savings, liquid savings, who are getting a better rate of return. There are some who think that because of the nature of our demographics, the nature of our savings pool, that it does quite a lot of offsetting. I'm afraid I don't really see that in the data. It tends to be that people bank that and don't really raise their consumption, whereas there's an asymmetry to interest rate increases. The negative impact of consumption from higher debt servicing costs is greater than the additional consumption you get from predominantly older people, but also affluent people having a higher return on their savings. So yes, a little bit of an offsetting effect, but certainly not anything like offsetting in full or generating a crisis.
And over the last, let me get my numbers right, 14 years, for a large part of that 14 years, we have had quantitative easing for a big chunk of it and kept interest rates at sub 1%. So very loose monetary policy. And you could argue this is now normalization. And it's how as we were talking earlier before the talk and also during it, is having interest rates that wherever we end up, 4 to 5%. Historically, that is more normal, obviously, than 1%. And in some ways, this day was always going to come. And how difficult is it going to be just to unwind that QE, but also just for us to get used to paying mortgage rates that begin with a 4 and a 5 rather than a 1 or a 2?
Yes, and I'm pausing in answering because there is both the cyclical upswing in interest rates as a result of a very rapid recovery, events in energy markets that are they might have been exogenous, they might have been temporary, but they've been of such magnitude that they've meant that the risk-free rate has had to rise. But John, you and I have spoken about this previously. There are other non-cyclical, what we would call secular changes that are also going on right now as perhaps a legacy of the pandemic, a legacy of trying to move to net zero, a legacy of very changing demographics in terms of the working age population, particularly in China, exporting deflation into the world economy. The difficulty is trying to disentangle which of those forces are making the biggest impact. And one of the reasons, if you like, why I sit somewhere in between is because I think both narratives, it isn't exciting to say this, but it's perhaps the most true. Both those narratives have some resonance. I think the inflationary pressure will start to ease as these big shocks, pandemic shocks, energy shocks start to dissipate. But I also do think there are good reasons to think that structurally, the type of economy we've got to build with shorter supply chains post-pandemic, a shrinking working age population in China and most of the developed world, is also putting upward pressure on interest rates and inflation. So normal to me does not look like the last decade, but equally there will be people on this call, I can't see the faces of all the people who are attending, but there are going to be people who remember 6, 7, 8, 9% interest rates and go, well, was that normal? I think the reality is it's boringly in the middle, which is most estimates. If you ask the Federal Reserve, in theory, the smartest people in the US and running the economy, they still think US R* equilibrium interest rates about 2.5%. That's probably a bit on the low side, but they still think a lot of those structural forces of the last decade have pushed equilibrium interest rates down. But it's certainly not 0 or 1, which we have been for most of those 14 years.
Fantastic. Well, Simon, once again, it was a real joy to have you with us for an hour. And again, we've covered large parts of not just the UK, but the world economy. And hopefully we're not in for too many shocks over the next few weeks. Like you say, dull is probably quite good for November anyway. But thank you very much for spending time with us at Landbay and some of our clients. It's really appreciated by all of us.
Huge pleasure. Thanks, John. And thank you, everyone, for your time.
Thank you very much.